Something fundamental is happening in the global gold market. And no, it's not just about the price going up. It's a signal, a warning that the entire monetary system we rely on is getting dangerously close to a breaking point.
In 2025, the price of gold didn't just climb, it surged an unprecedented 47%. Now, to put that in perspective for you, that's nearly double the performance of major stock indices like the Nasdaq and the S&P 500. We're talking about truly historic numbers here.
But here's the thing, this isn't just the bull market. A jump of this size points to something much, much deeper. It's telling us that a critical piece of the global monetary machine is starting to fracture.
So the big question is, what's the real driver behind this crisis? The answer isn't what you're seeing in the headlines. It's a structural conflict, and it's all happening behind the scenes.
Okay, first, let's talk about the cover story. You know, the mainstream explanations you hear everywhere. They're definitely part of the picture, but they're missing the single most pivotal mechanism that's actually at play.
The common narrative really boils down to two main things. First, the colossal amount of money printing since 2020 has pushed central banks to buy record amounts of gold to hedge against inflation. Makes sense. Second, the seizure of Russian assets totally spooked global powers. That accelerated a major shift away from U.S. treasuries and the dollar system, pushing them toward the safety of physical gold. Plausible, right? But it's an incomplete story.
The real story, the one that matters, requires us to look at the core mechanism, the conflict between the paper gold market and the physical gold market. And trust me, this distinction, it's everything.
The contrast on this slide is critical. On one side, you have the Western paper markets, COMEX and the LBMA. They're built on financial contracts, ETFs, and fractional reserves, all designed for speculation. But on the other side, you've got China's Shanghai Gold Exchange, which deals exclusively in physical, fully backed metal for actual delivery and ownership. Two totally different worlds. Now, this price difference has opened the door for a very powerful strategy: arbitrage. It's actually a pretty simple idea. You buy an asset in one market where it's cheap, and you simultaneously sell it in another market where it's more expensive. You pocket the difference. And right now, it's the tool being used to literally drain Western vaults.
Let's be really clear about this. The paper market operates just like a fractional reserve bank. It issues way more claims on gold than it actually holds in physical metal. This whole system works just fine, as long as everyone doesn't show up and ask for their physical gold all at once. But that very assumption is now being put to the test.
Some estimates put the leverage ratio as high as 500 to 1. Think about that. That means for every single physical ounce of gold sitting in a vault, there could be up to 500 different paper claims or promises for that exact same ounce. The entire system is built on the belief that those promises won't be called in all at once. And this little illustration shows you exactly how that's possible. Imagine there's just one physical gold coin. Person 1 lends it to person 2. Then person 2 relends that same coin to person 3, who lends it to person 4, and so on. Pretty soon, you have 5 different people who all believe they own that one coin. In reality, there's only one physical coin to satisfy all 5 of those claims. It's a game of musical chairs, and the music is starting to slow down.
This brings us right to the Shanghai arbitrage. And this isn't just some market trend. It's a calculated, strategic draining of physical gold from Western vaults, and it's exploiting the paper market's biggest vulnerability.
What's the psychological driver here? It's a complete collapse in trust. As this quote puts it so well, no one trusts that the house of cards won't come crashing down. So this huge demand for tangible, physical metal, it's basically a vote of no confidence in the entire paper system.
So here's how the play works. Sophisticated players buy up the cheaper paper gold contracts on COMEX or LBMA. Then, they do what you're not supposed to do. They demand physical delivery of the actual gold bars. They take that physical metal, ship it over to Shanghai, and sell it for a nice premium on the SGE. The result? London's gold stockpiles are shrinking at the highest rate ever recorded. The drain is very, very real.
You know, this is the first time a gold-backed system has come under this exact kind of pressure. History actually provides a chillingly accurate precedent for what we're seeing play out today.
And this isn't just happening in a vacuum. You can see the strategic shift happening right in the data. In a single month, February 2022, China sold off nearly $23 billion of U.S. treasuries. And what did they do with the money? They converted that paper debt into hard, physical gold. It's a clear move away from one system and toward another.
The historical parallel is the London Gold Pool.
Back in the 1960s, a group of central banks tried to suppress the price of gold to protect the Bretton Woods system. For about 6 years, they dumped physical gold onto the market. But by 1968, the demand for physical delivery just completely overwhelmed them, and the pool collapsed. And what happened next? The price of gold exploded by nearly 2,500%.
And just like back then, today we are seeing these desperate attempts to paper over the cracks. Reports of the U.S. leasing gold from other countries to make its own reserves look stronger, well, those aren't signs of strength. They're echoes of the exact same failed strategies they tried right before the last system collapsed.
So, this brings us to the endgame. Understanding this huge structural shift has some critical strategic implications for how we need to think about assets, about value, and about the future of the monetary system itself.
All right, let's boil this down to the pivotal takeaways. First, you have to recognize that demand for physical metal is fundamentally different from demand for paper proxies like ETFs. Second, all of this just underscores how important a truly well-diversified portfolio is. And finally, this intense demand for the physical stuff could have some major implications for gold mining stocks, the companies that actually produce the asset.
What we are watching unfold is not some short-term market fluctuation. As the source material puts it, this is the start of a new epoch in the story of gold. It's a long-term structural realignment of the entire global financial order.
This leaves us all with one critical question. As the paper market continues to fracture under the strain of physical demand, where is the world going to turn to find real, unencumbered value?